Good morning. You're watching Business World Live. I'm Danie Laurel. It's the start of a new trading day, but first let's kick off with our top story. The country's agricultural output fell for the first time since 2016. The slump was largely attributed to the pandemic, the series of typhoons that hit last year, and the African swine fever. Data from the Philippine Statistics Authority showed that agriculture output contracted by 1.2% in 2020. This is a reversal from 0.3% growth in 2019. This was the first time the sector recorded a contraction since 2016's negative 1.5% figure. The agriculture sector contributes to about 1/10 of the GDP. Now, in the fourth quarter, farm output shrank by 3.8%, and this dismal performance makes it unlikely that the fourth quarter GDP will get a boost from the agri sector. Fourth quarter GDP will be released later this morning. The PSA noted a drop in crops, livestock, poultry, and fisheries production in the last quarter when a string of typhoons battered Luzon. Agriculture Secretary William Dar says the sector remains resilient despite facing a number of challenges last year. The DA looks to achieve a 2.5% growth this year. That's after missing the 1.5% growth target in 2020. Okay, kicking off the market report with some negative sentiment. You can see on my terminal here a sea of red, not looking good when it comes to global equities. Now you can take a quick peek at Wall Street and how that performed overnight, down by 2.6%, the most since October. This happened amid the Federal Reserve officials leaving the interest rate unchanged over in the U.S. But more importantly, Fed Chair Jerome Powell saying that the U.S. economy was a long way to go from a full recovery and was still short of the policymakers' inflation and job goals. Now, even worse is how the shares are trading of the United States in other places when it comes to the futures. This after market close, disappointing results at Apple and Tesla came out, and that sent shares lower after the market closed. Now, what happened to the tech shares? Well, Apple shares fell. That's after a cautious outlook from executives had overshadowed what was supposed to be a quarterly revenue topping $100 billion for the first time ever. You've also got Tesla reporting lower than expected profit. And you've also got Facebook warning of significant uncertainty in 2021. Now, you can see on my terminal here, also over in Europe, quite some pain here. The German DAX down by 1.8%. The Euro stocks down by 1.6%. On that virus front over there, the United Kingdom has announced new rules to try and curb the spread of the virus. Germany had cut its 2021 economic growth forecast. Now, you can see the pain is spreading already at the Asian Open. You've got Japan opening in the back foot, the Nikkei 225 shedding 1.3%. Taiwan's TAIEX as well over in South Korea. So nothing really spared from the carnage here. And this, of course, moving over into Asian shares. Now, of course, let's take a quick peek at our own local boards and how we are performing compared to the rest of the world. It does not seem to be a surprising open here. We are heading and basically flattening at 6,800 levels already. That's down by close to 1% just at the open. Now, of course, the big data dump of the day is going to be the fourth quarter and full year 2020 GDP. That's out at 10 in the morning. Now, the survey is, of course, for a negative 7.9% growth year on year for the fourth quarter. So that's basically a contraction close to 8%, according to economists surveyed by Bloomberg. And that brings the full year to a contraction expected to be around 9.5%. But this, of course, will surpass our current record decline, which was back in 1984. So that was 7.3%. So if this does happen, that would surpass those declines decades ago. Meanwhile, I guess one bright spot here, if you could call it that, was that the third quarter slump of GDP was revised to negative 11.4% versus an 11.5% previously announced contraction. Now, of course, yesterday we had already already seen these declines. We fell yesterday as well to 6,800 levels. You can see us now closing in on 6,700 levels. This is already the lowest we've seen since December 1. We are now year to date. I'm just going to pull that out for you guys so you can see how we are now performing year to date, down already by close to 5%. This is going to be the worst monthly performance we've seen since at least July. Now, Jonathan Ravelas of BDO is saying that the economic outlook and the sentiment more and more bearish, saying that the stance of investors are more cautious. Now, recall that yesterday we'd already priced in that agriculture report that I just mentioned, contracting 3.8%. And in addition to that, the exports falling by 0.2% in December. Now, finally, I just want to show you guys how overseas investors continue to exit from or stage an exodus from our local bourse. You can see on my terminal here, we've seen 9 straight days of withdrawal. The total outflow in January is now at $180 million. Now, here to chat with us about all of these developments and more, we have with us Philstocks' Japhet Tantiangco. Good morning, Japhet, and welcome back.
Good morning, Miss Danie. My pleasure to be on your show.
Japhet, I hope it's a pleasure this morning, especially since we're seeing our index sliding down to 6,700 levels. Let's parse through the things that might be driving that. First of all, the GDP figures that are coming out. Has this not already been priced in? I mean, these expectations of contraction that's worse than since 1984, basically. Have investors not already put that into the price of the stocks?
Well, as far as we can see it, the GDP for full year 2020 has already been priced in. Investors are already expecting a deep contraction for the local economy in this past year. At most, they are expecting it to meet the government's expectations of about 8.5 to a 9.5% contraction. What investors would be looking more into right now would be the fourth quarter figures in particular, to see if there's going to be any significant improvement from the third quarter figures, because the fourth quarter figures, they will play a part. They will form as our base moving into the next quarters to come. So they will play a big part on how GDP will be moving forward, moving into 2021. So a significant improvement on fourth quarter GDP would be could give somehow optimism to our investors. So aside from as mentioned, the GDP has already been priced in. The plunge that we are seeing right now in the local market is more of a pessimistic expectations. If you remember, we started the year quite optimistic. I mean, we've reached about 7,200, which is what with a PE ratio valuation with a PE ratio of 25 times, about 25 times. And that was backed up by optimistic expectations. Unfortunately, we can see right now that the optimistic expectations, the economic recovery, the rollout of the vaccines, we're not seeing any narratives that are supporting such, and because of that, the optimistic expectations are waning. Add the entry of the new COVID-19 variant in the Philippine shores, which is putting new uncertainties into the table, and that explains why we are experiencing this deep decline that we are having right now.
Okay, Japhet, as you mentioned, there's of course this new variant coming in, uncertainty on vaccine procurement, etc. But is this sentiment driven, or is this also pricing in some fundamental data that we just got? For instance, exports contracting instead of actually going up, and especially in the months that people were expecting them to go up. Apart from that, the agri sector as well, which had been the bright spot during the lockdown and the pandemic, now seems to be waning. What does this tell you about our recovery path?
Well, if you're going to look at first the trade data that we have, yes, our exports declined by 10%, but our imports declined even deeper. And if you're going to look at the two, it resulted into a narrower. It resulted into a narrower balance of trade in goods, which is positive for the local economy. That's the bright side of that. But on the negative part, yes, because our exports have declined, then this is exports have declined. Then this is a sign that we are not our goods are not receiving much demand. abroad. At the same time, our imports are still down, which means that domestic demand with domestic demand or local demand with respect to foreign goods are not yet that strong, which gives us a bleak future with respect to our local economy. With
Mm,
respect to the agricultural sector, everybody was, as we all know back then, agriculture was the sole sector that was, tempering the
yeah.
decline in GDP. So everybody was hopeful with that. Unfortunately, yesterday we saw that even the agricultural sector, the value of its production has also declined. And because of that, it added further pessimism into the market, specifically with respect to the view of our local economy.
Japhet, is there some sort of consensus on how the offshore or just general global recovery is now going to be? Because, leading to Biden's election as president, there was so much sentiment that was positive on the fiscal side. That there was a lot of optimism on the vaccine procurement as well. And now there's a sudden slump when it comes to global stocks, especially after, earnings reports coming in. Where are the risks now tilted?
Well, with respect to the global recovery, everybody is still expecting a global recovery. It's just that this could be delayed. This could be delayed given that COVID-19 cases are still rising. Add the fact that you have these new variants, which is spreading across the globe, which is amplifying COVID-19 worries, the spread of COVID-19, which in turn may delay the global economic recovery. Now, going to zooming in to the U.S. in particular, yes, you have President Joseph Biden who is planning that 1.9 trillion fiscal stimulus package, and you even have Dr. Janet Yellen being confirmed as the Treasury Department
Mm-hmm.
Secretary, which strengthens the proposition for that 1.9 trillion US stimulus. It is positive for the US in the short run, but moving towards into the long run, of course, given the current status of the US economy right now, we cannot expect much from their tax revenues. So most of these 1.9 trillion stimulus plan, if it pushes through, will result into more borrowings for the U.S.
Mm-hmm.
economy, will result into more debt into the U.S. economy, and with this, the expectation is that in the long run there will be higher tax rates in the U.S. economy. In fact, even Janet Yellen has already mentioned this. And with the higher tax rates, of course, it's going to weigh on the U.S. prospects, U.S. economic prospects moving forward, and it may spill over to the rest of the world, including its trade and investment partners.
Okay, as us. And finally, Japhet, looking at this chart, where is the momentum headed? Is this, some analysts have called this a healthy correction after having rallied even to, as you mentioned already, valuations that are higher than 5 year moving day average. Tell us, with this now breaking the 50-day moving average downward, is this a trend for you, and do you see any sort of support level at the moment?
Well, chart wise, the market has a downward bias right now. I mean, first, we are looking at the 6,900 as the support level. Unfortunately, that was just breached yesterday. So the next support that we are seeing is 6,600. Now, if you're going to look at the market's 14-day relative strength index, you will see that it is showing a bearish divergence with the market. In the past 3 months, from November to January, you'll see that the local market has been forming higher highs, but its relative strength index has been declining, and because of that, there's this bearish divergence, which is pointing to a downward bias for the market moving forward.
Okay, so still being cautious there. Japet, last question. When should we be entering?
Well, I suggest that we wait for the market to fall to a strong support level. As mentioned a while ago, we are looking into 6,600. So let's see if the market will be able to confirm the strength of that level. Then that could be a good time for us to hunt for bargains. And speaking of hunting for bargains, I suggest that we be cautious. Not every stock is for the taking right now. We suggest that we look into those which have, good fundamental stories moving into
Mhm.
2021. Included there is still the consumer retail. You also have the energy stocks. And finally, you can also look into the banks.
Okay, so thank you so much for that. Don't be overexcited to
Yep.
enter right now. There's still some downward trends and risks on the table. Thank you so much for those insights. That was, of course, Philstocks' Japhet Tantiangco.
You're very much welcome.
Checking in on the other headlines, we're keeping our eyes on Oxford Economics sees the Philippines rebounding faster than its regional peers in 2021. That's because we are coming off a low base in 2020, of course, due to the prolonged lockdown. The think tank expects the Philippine economy to rebound by 7.7% this year after an estimated 10% slump in 2020. That's the deepest contraction in the region. Oxford Economics says Vietnam will also grow 7.7% this year, but that's after posting an estimated 2% growth in 2020 after successfully containing the COVID-19 outbreak. Meanwhile, the regional growth average for ASEAN 6 is projected at 5.3% in 2021. The group says a faster vaccine rollout could push this average GDP to nearly 10% this year, but a slower rollout and surge in infections might delay regional recovery to 2022. Now, intellectual property filings declined in 2020. That's as investors and creatives delayed applications during the lockdown. The Intellectual Property Office of the Philippines said applications for trademarks dropped 10%, while patent registrations fell 9%. Utility model filings saw the biggest decline, that's at 45%. Industrial design applications also dropped 23%, while copyright deposits fell 44%. Despite the low figures, the IPOPHL said they expected the drop since the economic uncertainty dampened investments in intangible assets. Although the group remains confident that the gradual reopening of the economy and the anticipated vaccine rollout may spur a rebound of IP investments this year. And this from the Philippine Star, the national government is eyeing to raise 140 billion pesos next month. That's by tapping the local bond market. The Treasury Bureau is scheduled to offer 80 billion pesos worth of T-bills and 60 billion pesos in T-bonds in February. The T-bill offers will be capped at 20 billion pesos each week. That's due on 3, 6, and 12 months. Whereas T-bonds will be offered on February 2nd and 16th, payable in 10 and 3 years. For 2021, the Treasury is programmed to borrow over 3 trillion pesos to plug the budget deficit, which is expected to widen to 8.9% of this year's GDP. And that's a first look into the business day. Today's Thursday, January 28, 2021. Catch Business World live for the market close. That's at 3:15 p.m. today. I'm Danie Laurel, and we are One News.